All right. Hello, and we are back. This is video 4, I believe. Jonathan and Joe. How you doing, Joe?
I'm doing great, Jonathan. How about you today?
Doing pretty good. Summer's coming to an end.
It's crazy, right? The mornings are cooler, the sun's setting a little bit earlier. But I've been thinking a lot about some of the things that are going on in the world and some of the questions that are being asked of us every day. What do we think about the election? What do we think about all the money the Fed's spending? What do we think about the stock market going up while people are unemployed? And, one of the things that made me think about is something that I say to my kids all the time. And that's, worry about that which you can control and try to take your mind off the stuff you have no control over. What do you think about some of these questions we're getting, and how do you think we should answer them?
Well, we don't have answers. We don't know everything, what's going to happen. I think we're getting these questions all of the time. And so, yeah, focus on what you can control. And one of those things that you can control is your spending, how much money you're saving. And for a lot of clients, it's their mortgage and how much they're paying in interest. And I think you and I both think that there's opportunities now, given how low interest rates are on mortgage rates, both 30-year and 15-year, that there's opportunities for our clients today.
Yeah, there's no question. In fact, I think, and maybe we can share a chart before we're done here, but I think that current mortgage rates are the lowest that they've ever been in history. And a lot of people in our position love to throw around superlatives and the ever and greatest and worst, but I do believe it's factual that mortgage rates are the lowest level they've ever been in the history of our country. And so it seems to me anyway that it makes a lot of sense for individuals to take a hard look at the mortgages on their current homes and understand that when and how it makes sense to refinance and what the benefits are of locking in a very low interest rate for the very long term. It has so many different potential benefits, not only cash flow, in other words, paying less money every month out of pocket, but also creating a fixed payment, let's say for up to 30 years at a time when, your income and your investments will likely grow, as will inflation, and that payment remains fixed. So, over time, that payment becomes a smaller and smaller piece of your total cash expenditures.
Yeah, and just to put numbers to that, I think the 30-year national average, give or take, is around 3.1%. And just a year or 2 years ago, it was 4.25%. So we're looking at mortgages of our clients today that are 4.5%. And so certainly there's a huge opportunity there, even if you just refi to another 30-year mortgage. Yeah,
absolutely. It's funny. Sometimes I'll talk with my parents and they'll tell stories about, how their mortgage payment was $112 a month when they bought the house that I grew up in, many decades ago. We don't need to get into specific length, but that just sort of plays to the whole idea that at the time, the payment probably seemed like a lot, but as time passed and inflation crept its way into our lives, that payment became a smaller and smaller piece of the total amount of expenses that they had. And today we have this awesome opportunity to lock in this low rate, whether it's a refinance, whether it's a cash out refinance, or whether it's just simply purchasing a new home and putting, very long-term, very inexpensive debt on it. So there's lots of benefits from my perspective. I ran a couple of quick numbers. In fact, I think the number you quoted, if the national average is 3 1/8 or 3 1/4 or so, there are many places to get lower rates. For example, we do some work with Schwab Bank that has a pretty competitive mortgage arm, and I've seen rates as low as 2 5/8 to 2 3/4 for 30-year mortgages. So if you run the number, if the average home in the U.S. is somewhere in the mid 300s, so I just did an example saying a $400,000 home you were to purchase. If you had purchased this 2 years ago at the average interest rate of about 4.5% on a mortgage, your payment would have been about $2,050 a month. Okay.
Yep.
So purchasing that same $400,000 home today at current rates is roughly $1,600 a month. So that's $450 a month less monthly cost, which equates to, something like, I don't know, $6,000 a year in lower cash flow requirements to purchase the same home today. I mean, it's crazy.
Yeah, I mean, $500 or $600 a month. You think about it, that could fully fund a Roth IRA, right? $6,000 max contribution, $500 a month gets you there. And
Yeah.
so you can refi, and then now all of a sudden you can also afford to max out your Roth IRA that maybe you couldn't have done a year ago because you were paying so much in mortgage interest. And now you can't.
That's exactly right. I mean, think about there's so many different things you can do with this savings, but of course you bring out the most prudent, and that would be to take that money and save it and invest it for the long term, and then you're further compounding your benefit. But I even took it one step further though, and I guess this probably in most cases is not what we would recommend, but with that additional savings, you could basically purchase almost $100,000 more house today for the same monthly cost, excluding taxes and insurance, of course, but just mortgage cost as you could have 2 years ago. So imagine, an extra $100,000 worth of house. So yeah, the idea of that cash flow savings, whether it's applied to investments, as you mentioned, Roth IRAs, purchasing more home, paying down other debt consolidation. Many people carry some credit card debt or potentially some other personal loans. Take that cash savings and pay down other places where it's costing you more money. I guess the point that I would make, and I don't know, tell me how you feel about it, is that these are some of the things we can control in an environment where many people feel like things are out of control, whether it's the political season, the health crisis, potential higher tax rates, some of the social unrest. I mean, we could go on and on about some of these uncontrollable things. And I think what we're trying to focus on for clients is saying, okay, what are some of the what are some of the things that have come out of these various, let's say, rolling crises that are going on? And one thing that's come out of it is the lowest mortgage rates in history. So we can actually take something that's potentially not a very good thing today with a lot of uncertainty and turn it into a positive that could last for a couple of decades. And if you save the money, as you said, it's even that much more powerful.
Yeah, no, I totally agree. I would just add a few other things. One of them, I've also urged clients to do this too, is to make biweekly payments. So a lot of people get paid every other week, right? And so, but most people pay their mortgage once a month. You can actually change it to biweekly payments. You end up making one extra payment over the course of a year. You'll end up with 13 payments instead of 12. So making that one extra payment per year will knock off about 8 years off a 30-year mortgage and about 20 to 25% of the interest cost. So that's huge.
That's incredible.
Yeah.
So
it's so easy to do that too.
So it's paying every 2 weeks instead of once a month, and that effectively is one extra payment a year.
Yeah. So the math is there's 52 weeks in a year.
Right.
So there's news to me. 52 weeks in a year. So every other week would be 26 weeks, right? That you'd be paying. And so that's really, 13 months instead of 12, divide by 4, you get 13. So, I mean, it's really easy to do. So yeah.
Right. So that makes a lot of sense for younger savers, your generation, people that are either in their first home or upgrading to a second home or refinancing that first or second home. It makes a ton of sense, right? Another thing that I just thought of is that we deal with several clients that are closer to retirement, and a general theme that we've always preached to people is it would be great to be debt free when you retire because it reduces cash flow requirements, et cetera. I might argue today that you could make an argument today that this money is so cheap for the long term that it may actually make sense to, rather than paying off your mortgage, consider refinancing the remaining balance into one of these lower rates as well, because it's a pretty low hurdle after you factor in the tax deduction of this interest as well. So, remember, you get to deduct, I think it's $700,000 now, $700,000 home purchase, you get to deduct $700,000 mortgage. You get to deduct the interest costs annually, right? So, so you think about it, if you're, 2 5/8 or 3% cost of money and it's tax deductible, you're reducing that cost significantly.
Yeah. And, the other option, of course, is doing a cash out refi. So I've worked with a few clients on this. They were actually hoping to pay off some high interest student loans, maybe $20,000 or $30,000, and they're paying 6, 7, 8% interest, and student loan costs haven't exactly gone down like mortgage rates. So that
which
spread
by the way,
between,
doesn't seem fair. But
no, it's totally not fair at all. So they're paying 6, 7, 8%. Now they can do this cash out refi where their new mortgage payments at 3%, saving that 5% in interest, and paying off their student loans quickly if they have enough equity in their home. So that's definitely a great option too. Or for clients that want to add another kitchen or remodel or whatever that is, I mean, use the equity in your house at these low interest rates today.
right, yeah, and I think that's really the key point that I wanted to make today is, again, worrying about some of the things you can't control, and this is one of those. This is
Yeah.
one of those silver linings that's come out of an otherwise pretty trying period. So I don't think that it makes sense for everybody, and I think that everybody's situation is different. But we do encourage you all that are listening to take a look at the value of your home, your existing debt, and your current mortgage, and let us help you take a look at if it makes sense to consider refinancing your mortgage, adding a mortgage to a home that's paid off, or doing a cash out refi.
Yeah, absolutely. And we have all the capability in our financial planning software to run all the analysis there for you. So we're doing this all the time. And like you said, Joe, this is something you can control, and you don't know how long rates will stay this low. If they'll stay low forever or they'll go back up. So let's take the opportunity now to do something.
Yeah, fully agree. So, all right, great. Reach out to us with questions and comments, and we look forward to talking to you again soon.
All right, take care.